Ben here from Bounce Financial. Today I'm going to quickly run through a presentation that's usually very popular that we give about how we prepare our clients for private education. Now, in some of these webinars, I've been a bit lengthy, so what I'm going to do is try and get through this information as quick as possible. But obviously, if you have any questions, please reach out. So without further ado, let's get started. I'll just minimize myself here. All right. So preparing for private education. So what are we going to talk about today? There we go. Today we're going to talk about some of the statistics and costs of private education, particularly in Brisbane, which is where our office is located. For some of these issues, they do relate to many different states, right? But obviously, different schools are going to have different prices. So it's definitely worth investigating prices of schools in your areas. We're going to address some of the common things that people say to us about how they're preparing for private school, and perhaps explain some of the problems that can exist if that's the way you approach saving or investing for private school. We're then going to run through a case study of a usual family in Brisbane and how private school affects their budget. So you can start to see how big a deal this is. We're then going to run through the steps that we go through with our clients to identify how much money they're going to need for private school and how we can go about preparing the financial plan to include that money. We're then going to talk about some of the investment options we consider for our clients, including things like education schemes, which are really popular at the moment, and investment bonds. And then finally, I'm going to give you a bit of a summary of the steps to take. So if you're interested in that, please keep listening. If not, understand. Please have a look at some of my other webinars. We've run through a few different topics which might be relevant to you. Okay, so quick disclaimer, as always, we don't understand your personal circumstances, and finances are very, very unique. So please make sure that you seek professional advice before acting on any of this information. This is just general in nature and does not take into account your circumstances. Cool. All right, so let's talk about some of the costs of primary and high school. So at Bounce Financial, we work with a lot of people that are putting their kids through different private schools. So we're experts in private schools. We know how much they cost. We know about the processes that you have to go through to get your children into private school. So what I've done is I've included here a bit of a summary of the different costs of different levels of private school. Now, obviously, this varies from school to school. It varies based on what grade they're in. It varies based on different technology costs. But we've given a bit of an average so you can see how much they cost. If you want to know how much a school costs, most of them put those details on their website. So simply Google something like the school name and fee schedule will usually lead you to the cost of that school, and you can make some decisions from there. So in the Brisbane market, for example, some of the schools that are under 10,000, we've listed there. So Cannon Hill Anglican, St. Lawrence, things like that, between $10,000 to $20,000 a year. And again, this is primary school. We've got things like Anglican Church, Grammar, Nudgee, Somerville. Somerville's towards the top end of that. And then we're looking at schools that are in excess of $20,000 per annum, and that's things like Grammar and things like that. When it comes to high schools, the fees tend to jump up quite a lot. So we've listed there the schools that are up to $10,000. So St. Laure's, the Australian Christian College, between $10,000 to $20,000. There's things like All Hallows, Marist College, like a Stuart Home, things that you're probably familiar with. And then once you exceed that $20,000, there's quite a few in there. So Somerville's, Boys Grammar, things like that. Generally, high school costs are higher because obviously there's more cost in delivering a high school experience, or perhaps I assume. Okay, cool. So that gives you a bit of perspective of how much these schools cost in case you're a bit unsure. Okay, so some of the common issues and common thoughts we hear from our clients about saving for private school. So one we hear is, I'll just earn more money when we get to it. And I love optimism. Optimism is awesome, but we have a bit of a approach to finances where we plan for the worst and expect the best. That's what we want. So yes, you may hopefully be earning more money by that time, but it's important for us to start putting in plans. Worst case scenario, you do get to that time and you are earning substantially more. It just means you have excess money. Having excess money, never a bad thing. One thing I hear quite regularly is we'll cut our spending when that happens. And I'll show in some future slides how much this can have an effect on your budget. It is very challenging to cut that level out of your budget. Most people, they're not spending ridiculous. It's not like they can just cut just insane things they're spending. Most of those costs generally are life costs. And if you say to yourself, look, I'm just going to go 12 years without doing the things I love, it's probably not sustainable. Another one I hear quite regularly is I'll just borrow against the equity in my home or use the equity in my home. Now, I think there's a bit of a misconception about what equity is. Equity in your home is just how much of your home you already own. And all you're doing when you use the equity in your home is you're saying to the bank, well, I'm willing to put that up as collateral. You're still borrowing the money. You still need to pay back the money. It's just borrowing. That's all it is. And we want to avoid borrowing more money because what you're going to be doing is paying interest. And that interest is going to add up. You could end up paying thousands and thousands and thousands of dollars more by the time that you have paid off that debt. We want to avoid that if we can. The other is that they'll take out a payment plan. And again, yes, there are payment plans that are available, but you're going to have to pay quite a lot quite quickly. So it's very important that we start preparing for this, and we do it as early as possible. For some of our clients, they've just had children, and we're already talking about this, even if they're talking about only high school, because we need sort of 10 years plus to really prepare for this big expense. Awesome. Okay, so what I've done is I've done a case study of what is a pretty standard Brisbane family, right? Obviously, our clients come in all shapes and sizes, so this isn't necessarily indicative of a usual client, but we just wanted to show what it would look like where a husband was earning $120,000, perhaps the wife was earning $60,000, or the other way around. They've got 2 kids. Their household spending is around $100,000 per annum, and their home loan repayments are around $30,000. Now, that may seem like quite a lot, but that's actually pretty standard for our clients. And in fact, my level of personal spending is relatively consistent with that. So expect that is pretty normal for a family. Now, what I've done is I've done 3 scenarios where what we do is we indicate private high school at $10,000, private high school at $15,000, and private high school at $20,000. And I'll show you the difference that makes to their budget. Okay. Numbers. It wouldn't be financial planning if there wasn't numbers. I'll put my little face up there. Okay, so this looks very complex, but let's talk it through so that you can understand what it is. So this is something we do for our clients, and what it is a year-on-year assessment of how much money you have coming in, which we call inflows, and how much money you have going out, which we call outflows, which leaves a remainder of money that either you have surplus or not enough, and that's called cash flow, how much you've got left at the end of it. So you can see at the top, we've got the financial years. So each column is a year, and the first 2 rows are partner 1 salary and partner 2 salary. So you can see that they're earning $120,000 and $60,000. So that means together they're earning $180,000 in that first year. Now, from that, they both have to pay tax. So you can see that outgoing of tax. And then there's the school expenses, which don't kick in the first year. Just wanted to show what that would look like without them paying school expenses. The mortgage repayments are there. And then there's the lifestyle expenses. And you can see that their total inflow for the year is $180,000 in that first year, that 2019-2020 year. And the total outflows is $175,000. So therefore, they have $4,166 left over, which is good. They're in a surplus. It means they're saving money. The next year, what we do is we increase these by 2% because generally people get pay rises, costs go up, and we've consistently done it. So these figures change, but only slightly. And you can see the next year, same thing. They save some money again. The year after that, however, the first child starts school at $10,000. And you can see at the bottom where it says cash flow, when they were previously saving money, they're now down $6,240, which means they need to either address that with borrowing the money or they need to cut their expenses to address that. The next year, which is 2022, 2023, again, they're $4,000 down, which again, they're going to need to find that money. The year after that, however, 2023, 2024, they're down 14,000. And that's because both kids are in school. And this is where things start to get really challenging because each year they have to borrow more and more and more money. And you can see we have the cost of borrowing, which is the third row from the bottom. That adds on, that's the interest that's payable for that. So, for a family that earns relatively well, 2 kids at a school that's paying $10,000, they need to start preparing for this. Otherwise, they are going to be in deficit. Now, the most deficit they have is about $16,000. You can see that in the 26-27 financial year. That's not an easy amount of money to find. If you had to cut $16,000 a year from your budget, you would definitely feel that. So it's something that could be achievable, but it's something that would be very, very challenging. Cool. So scenario 2, we've done the exact same scenario, but what we've done is we've done $15,000 high school for both children. And this is just to show the differences as you start moving up. Now, you can see in those first couple of years, because both kids are not at school, they're saving money, which is good. The moment, however, the first child goes to school at $15,000, you can see that their cash flow is negative $11,000. This escalates every year, particularly once both kids go to school, and peaks at around $28,000, $29,000 each year, which kind of gets to a point that it's not reasonable to be able to cut that out of your expenses. It's not really possible. So savings really need to have kicked in prior to that to afford a school like this on this sort of salary. Cool. Moving to scenario 3, $20,000. So as you can imagine, as we move from $10,000 to $15,000, it got worse. As we move to $20,000 for 2 children, it gets substantially worse. And you can see once the first child starts school, then they're down $16,000. By the time both kids are at school and they're at the peak period, they're down nearly $40,000 in the year, which is just not achievable, right? If they haven't prepared for this, they're either going to have to borrow substantially to achieve this, and borrowing hundreds of thousands of dollars, or they needed to plan ahead and save for that prior to that time. Awesome. So the reason we showed that is just to get a bit of a scenario of like, this is, it's going to have a big deal on your finances. And it's just something we need to prepare for. So awesome. Keep moving my head. Awesome. Okay, so the steps we go through when a client has a child and they want to talk about private school. The first thing we do is we identify the school that fits their needs, right? So everyone's got a bit of an idea of what school they'd like to send their kids to, but largely your salaries or your capacity to save is going to reflect the school you can afford. So we just do a simple calculation when we say, how many children will you have? How many years in school will it be? So is it just high school or is it all of them? What's the school fee and what is the cost? So for example, if you wanted to put 2 children in private high school at Marist College in Ashgrove, we've assumed that's about $139,000. And that's the figure we need to work with. Can we get $139,000 saved or prepared for that time? So we don't have to go into debt or into substantial debt at least. Okay, so step 2 is we overhaul the budget. So once we know what we're saving for, we need to work out how we can save that amount of money. Now, really, it doesn't matter how much you earn. It matters how much you spend. So, if you earn $200,000 a year, but you spend $200,000 a year, it's not going to work. Somebody who earns $100,000 but spends $80,000 is going to be in a far better position. This is a strange way of thinking about it. To us, we're always saying that wealth is not your income. Wealth is the gap between your income and your expenses. And it's not necessarily our most high earning clients that are our wealthiest. It's generally the people that have separated that gap. Now, don't get me wrong, earning lots of money helps. It helps substantially. But you need to reduce your expenses as much as possible to get that gap as wide as possible. So how do you overhaul your budget? Okay, so look at your spending and be thorough. So the way we do that is we use a budget calculator that we've produced. And if you'd like a copy of that, please be in touch and I'll email it through to you to work out what people's life costs are. This is how we come up with that figure of, say, $100,000 plus the $30,000 in mortgage repayments. As a general rule, our clients sort of spend about $120,000 a year on average. So if you're around that figure, that's relatively standard. If you can bring it down a bit, that's great. You want to reduce your debt. So things like credit cards, personal loans, Afterpay, even your home loan, the more you can reduce that, the less interest you're paying, which means you have more money left over. That's the goal. Getting out of debt is fundamentally important to growing wealth. Credit cards, personal loans, and Afterpay, we need to address them straight away. Home loans, it's important that we have a sustained strategy to pay that off quicker to avoid the interest that's going to accrue over the life of that loan. Now, the third thing we like to do is talk about getting all your financial ducks in a row, and in particular, income protection insurance. So a lot of this plan is based on the fact that you can earn money and you can continue to earn money. And if it's the case that you have an injury, something happens to you, or you get sick and you can't work, the last thing you want to do is have to pull your kids out of school. If you have income protection insurance, it will pay a benefit which will allow you to continue to pay your expenses, including school fees. So it's important that we have that in place. It's very optimistic to think nothing's going to happen to you. Things happen to people. There's no rhyme or reason as to why it happens. Sometimes you're just unlucky. The final thing we work with our clients for is automating their finances. So once you've come up with a plan as to how much you want to spend, you want to structure your bank accounts in such a way that you have automated your finances. You know how much is fund spending money, how much is set aside for bills, and how much is set aside for your different goals, which may include children's education. And if that money is being automated, it's going to all those different places and being separated, then you can easily act on your budget. You don't have to, every time you want to buy a coffee, think, is this in my budget? That's not the life you want to live. Awesome. I'll rush through that. Please be in touch if you have any questions. Okay, step 3. So step 1, we have worked out how much it's going to cost, what we're aiming for, and whether it's even a school we can afford. Step 2 is overhauling the budget to work out what we can save. And step 3 is how long have we got? So if you can save $10,000 a year, that's awesome. But if you've got 1 year to save the entirety of the money, it's probably not going to be enough time, right? The longer you've got, the better. So we always say, how old is your oldest child? When will they be starting school? And what will you have if you save that extra cash? So we have an example there. So if you have 4 years until your kids start at Marist College, you can save $6,500 a year over the next 4 years. It means you can have $26,000 before any earnings, which we'll talk about that in a second. This means your shortfall is going to be $113,000. That's substantial, and it's going to be challenging to address. Now, it might be the case you want to borrow it, and that's fine, but understand that borrowing is going to increase that cost substantially, and it's going to put back your other financial goals. Awesome. So step 4, direct excess cash flow for the future. So once you have worked out how much you need to save, how much you can save, and how long you've got to do it, you now start thinking about, okay, how can we use that money to potentially earn more money? So for example, if you've saved $10,000 per annum, we can now consider the investment options that are appropriate, right? Some people we find choose the school before they've gone through these steps. And this is kind of a bit challenging, right? Because it might be that that school doesn't align with your capacity to save. And it might be the case that picking a different school would mean that you're able to get a better quality of life and also achieve the goal of sending your children to a school that you're happy with. So it's really important to kind of go through these steps first. Now, I'm going to talk about the different investment vehicles that we use for our clients and how we work out whether they suit them. But largely, this is very focused on the individual person and the individual circumstances. So please do a lot more research before you sort of go down this path. Okay, so there's a couple of investment vehicles that might suit this. We'll talk about this. So the first is cash and term deposits, so putting it in a bank account. The second is investment properties. That's something people want to talk about. The third is investment portfolios and investment bonds. And the fourth is education schemes. And I'll talk through both of them. The first thing I want to talk about, however, is the investment properties. Investment properties can be great investments. We have a lot of clients that have gone down that focus for their investments, but they really don't suit children's education. It's very rare that there's going to be a circumstance where they suit children's education. And here's the reason why. So an investment property is a high-risk strategy. I know that sounds shocking to a lot of people, that it is a high-risk strategy, but it is. Because what you're doing is you're borrowing other people's money and you're hoping that you can exceed the interest on that, which is a high risk. Generally, you shouldn't be going down this path unless you feel very sophisticated in this area. Most of the time when you purchase an investment property, the income you receive from the rent does not cover the entire cost of owning that property. If it does, it's usually only, it's very rare that someone has a lot of surplus income until they've paid off that house much later in life. So you're not going to have rental income coming in so you can pay for school fees with them. That rental income is going to be covering the cost of that investment property only. So not super helpful for that. Now, when you get to the period where you would like to access some money, so say you're paying down your investment property, that's great, you're getting a bit of equity in it. You can't just sell off a bedroom each year when you need money. You have to sell the whole property, which means on the first, say your children are starting private high school, year 7 comes around, you have to sell the whole property. You are earning no investment money from year 7 to year 12. Now, say you've got 2 kids, that could drag out over multiple years and you're not investing. So investment properties really don't suit education. They're very much focused towards a very long-term strategy. So if investment properties don't work, what does work? And we like to think of things in terms of timeframes. So what we've got is cash and bank accounts, investment portfolios, and investment bonds. So if a client comes to us and says, look, we got 1 to 2 years, we can save pretty well, but we don't have much time, then generally putting the money into a bank account or a term deposit makes a lot of sense. It doesn't earn a whole lot of money, but it means that in 1 year or 2 years, when you go to access it, you'll know exactly how much money is there. It's completely risk-free. It's a great way of doing it. Another great way is your offset account on your family home, or alternatively, if you have the ability to redraw, that's something you might want to consider because it will reduce the interest you pay on your house. If you are looking at a period of 3 to 10 years, this is when you can start talking about investment portfolios. So investment portfolios, I won't go into way too much detail, but it's essentially investing in companies, shares, things like that. They're very flexible. There's low startup costs, relatively low fees. You can diversify. So generally, when we invest for our clients, we don't just pick 3 companies. They're invested across hundreds of companies across many different places. So many different in Australia, the US, the UK, all over the world. And this means that it provides a level of protection. If one company potentially goes out of business, it doesn't affect your portfolio. Whereas, if you say invest in BHP and then BHP has a bad year, your investments do bad, right? The cons of this, and the reason you need time frame of 3 to 10 years, is there are market fluctuations. So investment values go up, they go down. And what you want to do is be in a position when you need to access that money where you're a bit more certain about what the value is going to be at that time. If the market is slightly down, you might want to wait for it to go back up again. And that doesn't really suit short time frames because you don't have time to wait a couple of years for it to go back up again. Okay, let's talk about investment bonds. Now, investment bonds are very, very complex. They're not too bad once you learn the rules, but they don't make a lot of sense. There's a bit of a long history of how they came to be, and they're a bit strange. But essentially, if you are investing for greater than 10 years and you both earn relatively high amounts of money and pay a fair bit of tax, investment bonds can be a great investment vehicle. Because what happens is you don't pay tax in your name on those investment bonds. Now, those investment bonds get taxed at a lower rate, the company tax rate, throughout the life of them. But if you're earning a lot of money, that's generally a lot less than your tax rate. So a little bit complex, but they can be of really great advantages. They're relatively low cost. They're easy to set up. They're flexible. The only real restriction is this 10-year requirement. And there's also requirements about how much you can put in before you can no longer get the tax advantage. So you need to be really careful that you comply with all the rules associated with an investment bond. Awesome. Okay, so summary, short time frame, cash bank accounts, medium time frame, investment portfolios, long-term time frame, and high earning couple, investment bonds. Let's talk about education scheme investments. So education scheme investments, you may have seen things about this. If you haven't, have a Google. Essentially what they are is investment bonds, but they limit you to putting that money towards education. This can be good because it sort of restricts you, I guess, from using the money for other reasons. But the thing about 10 years is things change. So you really, I mean, we like the flexibility investment bonds provide over education scheme investments. We find there's a lot of restrictions that are in these education schemes, and not necessarily a lot of benefits that offset that. But it's worth looking at each individual one because they're all different, they're all unique, and understanding what the rules are with it. Cool. All right, so how do you prepare? I apologize that I'm rushing through this. Okay, so there are some financial things you need to do, but there are some non-financial things you need to do. So, you know, you may already know this, but you need to get on wait lists really early. You need to apply in advance. You usually have to pay a non-refundable application fee, and you may have to do this across various schools. Now, another thing you might want to do is you want to check catchment zones for your area. So, it might be the case you've got your heart set on private school, and that's awesome. But it's always worth knowing what the public school in your area is that you would fall into the catchment, so you can make a more informed decision. There is a website in Brisbane. If you'd like, you can Google it. But if you can't find it, please reach out and I'll send it through to you. It makes it super abundantly clear what school that you would fall into the catchment for, and this may change the way you look at things. Another thing you can do is investigate whether there are any scholarships that are available to you. So that's always worth checking out because there are scholarships available for different reasons. Now, financial things you need to do. So once you've figured out the school you want to go to or can afford, that's really the important one. You've got to go through the steps. So step one, figure it out. Step two, overhaul your budget and figure out what you can realistically save. Step three, work out how long you have to work with. And then step four is direct excess cash flow towards those investments based on those timeframes. Awesome. At this point, I usually answer any questions, but this webinar is just a video, so I doubt I'm going to get any questions. If you have any questions, please feel free to reach out. We're always happy to talk about these things. We try and put out as much content as we can on our social media as well, so you may see some things about education because it's very, very important to our clients. If you have any questions, I can be reached at Ben@Bounce Financial. Otherwise, have a really great day, and thank you for spending the time with me. All right, cheers. Bye.